We have seen people's incomes absolutely destroyed. 1 in 6 in Canada could default on a major loan, and the banks have huge exposure to both business lending and mortgage lending here in Canada, and we're going to dive through all the risks in this video. RBC, TD missed profit estimates as bad loan provisions climb, CIBC beats. Now, the reason I'm bringing this up is because as later on in this video, when I show you how many loans they have, the amount they've increased their provisions by is just ridiculous. It's less than 1%. So this is really nothing. And then this article came out by Seeking Alpha. So Royal Bank of Canada, plummeting home prices could trigger mortgage default risk event. So compared to US banks, Canadian banks, specifically RBC, have greater negative exposure to the mortgage market due to differing default insurance standards and higher home prices. As Canada's mortgage rates spike, its home prices have begun to collapse, pushing borrowers underwater and risking default amongst many variable rate borrowers. The Royal Bank of Canada is less risky than US banks. I don't agree with that. However, I do not believe it's a huge valuation premium is justified in light of the growing mortgage market risk. And that's what Seeking Alpha said there. So how does RBC stack up against US banks? RBC is huge with around $2.1 trillion in assets, making it the 5th largest bank in North America. Just remember that the 5th largest bank in North America with this much risk exposure is just insane. So the bank operates at higher overall leverage than most US banks, with a total liabilities to assets of 94.5% compared to most US banks of comparative size being closer to the 90 to 92% range. RBC has a CET1 ratio of 12.7%, liquidity coverage of 130%. So then it goes on to say about the M2 money supply and basically how it's declining in the US and it's still rising in Canada, and basically that's a measure of deposits. So Canada home bubble creates large risk. Around half of RBC's loan portfolio compromises of mortgages, equating to around $355 billion. 76% are uninsured and 24% are insured. 76% of those mortgages are uninsured. Just remember that. That is an insane amount of exposure to the mortgage market. The Canadian mortgage market differs from the US market as only higher risk mortgages are insured, akin to the US FHA system. However, unlike the US, most mortgages are not insured from default by a government agency. This situation leaves RBC at greater risk in the case of a more extensive mortgage crisis, although like Europe, most Canadian mortgages are recourse. I don't know why people always say that about the recourse, non-recourse, because in the US, it was only some states which had non-recourse loans. So places like Nevada, Las Vegas, for instance, where home prices collapsed, they have recourse loans. It didn't stop home prices collapsing, didn't stop people walking away from their house. I mean, at the end of the day, the government came in and said, hey, we'll do the cash for keys program to get people out. You know, when a lot of people default, the bank is not going to be going after individual court cases, you know, so it's just kind of ludicrous to go down that route, but I think it's interesting to talk about it. Although, like Europe, most Canadian mortgages are recourse, unlike the US, allowing lenders to target borrowers directly in the case of default, which won't happen, as I said. The FICO scores on RBC's uninsured mortgages are high at an 805 average, 69% LTV, meager 90 plus default rates, 9 basis points, and a higher portion of variable rate mortgages, 37%. That's an insane amount of variable rate mortgages, an insane amount of risk exposure to uninsured mortgages. And the credit scores, they mean nothing because we've gone through that NBER report that was released in 2015, which was about the 2008 crisis and how actually prime borrowers, they were the ones who caused most of the foreclosures. So, you know, that's kind of a myth that people have about the global financial crisis. Problematically, Canadian home prices are incredibly high compared to incomes, and as interest rates rise, are falling quickly. Last year, Canada boasted the second highest average home price to income ratio amongst all 38 OECD countries. That's a great reason to move to Canada. Second highest home prices in the OECD countries that they measured there. Canadian home prices are exceptionally high in its largest cities, particularly Toronto and Vancouver, with price to income ratios averaging around 12x. To compare, the housing bubble peak US home price to income ratio was around 6.8x in 2006, although that figure is now higher at 7.6x today, indicating US home values are more overvalued than they were in 2006. The surge was triggered by the decade of ultra low interest rates in the 2010s that naturally pushed home prices higher, since buyers are mainly focused on payment affordability. And that's kind of the problem, actually. And then it shows the Canadian house price index and the mortgage rates that have gone up. And then it's saying about mortgage costs soaring and the pressure that that's putting on homeowners. And as we're going to go into right now, that pressure is building massively. So 1 in 6 Canadians say they are likely to default on a major loan as rate hikes pinch. So that is just really bad when you really think about it. You know, if 1 in 6 did default, that would be huge, and the bank's loan loss provisions would not cover it. So in the latest edition of the Canadian Maru Household Outlook Index out this morning, 1 in 6 Canadians say they are likely to default on making payments on a major loan or mortgage in the next 60 days. That's up 2 percentage points from the month before, and the highest level since Maru began tracking Canadians' views on their personal finances and the economy in 2020. And you know, in 2020, at certain times, that was insane. I mean, the pessimism was absolutely crazy. And then the stimulus checks, the massive flood of the amount of cash that the government created through deficit spending came in, and that kind of created this false narrative that everything's okay, the government saved the day, the bailout worked, and here we are in 2023, and it's all about to unravel again because they fixed things so well in 2020. Nearly 85% of those polled said they are more worried about the elevated costs of everyday goods like food and gas rather than borrowing costs. Really interesting. Another survey by Statistics Canada out yesterday found that 1/3 of Canadians reported having difficulty making ends meet, with 26% saying they would be unable to cover an unexpected expense of $500. That is just absolutely crazy when you really think of that, and just shows the amount of distress there, and that borrowers are literally getting to the end of their tether and they're going to have to default. I mean, they've literally said it, 1 in 6. So that's all coming. And it's kind of insane when you look at the long-term debt that RBC has. It has $448 billion in long-term debt. And then you look at the amount of loans that they have, $835 billion. And their loan loss provisions, you know, they might have increased it by $500 million. But that is absolutely nothing when you're talking about $835 billion in loans that they have. That's absolutely nothing. A lot of those are business loans. We know that that's a private sector debt bubble. We've discussed that before. It's absolutely insane at like 300+% of GDP. And then you've also got the household sector debt bubble as well that's going on. So it's just people are able to take on debt until they can't take on debt anymore, until they're maxed out essentially. Their income doesn't even cover the debt payments anymore. And that's exactly what's happened, because if you look at the negative amortization shit that's going on, that is essentially why that's happening, because people can't afford to pay the loan anymore. Otherwise, those loan balances wouldn't be increasing and it wouldn't be such a significant portion. Those of us that are in the know can see the distress, but a lot of people can't, apparently. It's just kind of insane. And then the other thing that I want to take you through is like the real wage growth is just abysmal. And we have seen people's incomes absolutely destroyed. So if we go to around this level down here, which is around 2022, you can see that at the worst, real income growth was minus 12%. And I'm using the 1980 CPI from Shadow Stats because, quite frankly, we all know the CPIU, the CPI, is completely inaccurate because they're constantly changing what goods are in that CPI. How can you have a historically accurate CPI if they constantly manipulate what they're measuring? It just doesn't make sense. But that's the whole goal. They want it to seem like it's lower than it actually is, whereas the 1980 CPI is a fixed basket of goods. And we can see that it's not only been like that in 2022, it's been like that for a long, long time. Negative real wage growth. In fact, the only year that it went positive was 2009 and 2020, both times after government bailouts. And here we are in 2023. And you know, those rates right there are abysmal. Like Like if we look at that one in 2009, it was 0.70%. Just insane. And in 2020, it was 1.23%. That doesn't even make up for the past of that. 2.71%, 3.19%, 2.08% the prior years. Doesn't even make up for that. The losses there. So it just shows you how little people are making. Little do they realize, because they're able to take on all this debt. They're able to take on all these debt, and that kind of covers the costs that they're losing because of their income. But it only happens and goes on for a certain amount of time. It's a debt bubble. They've played out many times in the past, and I don't think I need to tell you the story of what happens in the end. So it's really kind of crazy. Once again, I just want to show you this 835 billion in loans on the Royal Bank, and then you can see their income has actually grown by the same amount as the loans, which, you know, makes sense. And you can see how the bubble, as we discussed before, really started to go parabolic in 2004. And look, that is where the loans just absolutely took off. You can pretty much look at RBC as a company, and it is so tethered to the economy and home prices that if either are in jeopardy, then guess what? That bank is at serious risk of getting into difficulties. And that looks highly likely as the yield curve is at the worst inversion it's ever been since the 1990s. And that was a huge banking crisis and crash that happened then. So it's kind of crazy, guys. So if you've enjoyed this video, you might like that video there. You might also like that video there. I want to thank you for watching. Please don't forget to sign up to the free emailing list in the description. I'll see you in the next one. Take care.